Hi, I'm Joe Sparling. I'm an IFG franchisee, and I'm speaking with you today from my bunker here in McKinney, Texas. Now, since IFG is a global company, this video is going to be made available in two different languages, English and Russian. So you take your pick on which one you'd rather listen to. The purpose of this video is to explain to you the conversation that you'll have when you receive a call from your prospect and you've talked with that person and you've already done your pre-qualification. That means you have the background information on the prospect and you feel like that our service can help this individual's company. So now you're in the position where you need to explain how our service works and what the cost is to the prospect. You'll be selling. Now, our process and our pricing are pretty simple, but from experience, I can tell you that if not explained properly, it can be very confusing to the prospective client and to yourself, and it can greatly diminish your chances of doing business together. So that's why we need to kind of get it down. Here's an outline. All right, the first thing that I generally do is I discuss factoring in somewhat general terms. I usually start by asking if they're familiar with factoring. And they may tell me that they've never heard of it, or they're vaguely familiar, or that they are extremely familiar with it. And it generally doesn't make any difference to me. I'll usually respond by telling them that factoring is a very old industry. It's almost 5,000 years old, and that it even preceded the banking industry. Now, the difference between factoring and banking is that banks are lending money to you. Factors do not lend money. We purchase accounts receivables at a discounted price. That's why there's no interest rate when we're talking about factoring. Now, there are basically two types of factoring. 95% of the industry is made up of the traditional standard factors, and the remaining 5% are non-traditional, non-standard spot factoring companies. IFG is an example of a spot factoring company. S-P-O-T, spot factoring. Now, there's a big difference between standard factoring and spot factoring as well. Standard factors usually require that you sign up for a 1 to 2 year commitment. And in addition to signing the 1 to 2 year agreement, you're also responsible for producing a minimum amount of receivables every month to finance, whether you really need to finance or not. If you don't produce that minimum, then there are penalties that you will have to pay. Standard factors also control and administrate your receivables. Now, standard factoring works very well for some clients, but I can tell you, if you qualify for spot factoring, there's a big difference in the way it will work. In spot factoring, there is no time commitment to use our service. It truly is a use it as you need it service, and you can actually use us once and never use us again if you don't want to. Our agreement basically says if you would like to sell us invoices and we would like to buy them, under what terms and conditions that will happen. There is no obligation for you to sell to us. You only finance when you need it and for how much you need. And we never force you to finance every month or force you to finance most of your portfolio, and we're not going to administer or control your portfolio. You are in charge. You decide when and what to finance. And this is really the big difference between standard factoring and spot factoring. Now, factoring can be a very expensive service. You can't compare factoring to traditional bank financing. In fact, I tell you, if you qualify for a loan or a line of credit with your bank, then you should probably take it. But if you're not currently qualified for banking, then factoring is the best thing for you. And you know how it works with banks. They'll qualify you when you don't need it, but when you do need money, you never qualify. All right, so anyway, staying on that track, factoring can be expensive. Spot factoring can be expensive also. But unlike standard factoring, spot factoring has no application fees. There are no hidden fees, no every transaction fee, and there are no penalties. We just purchase invoices at a discount. Our discount applies to the total face value of the invoice, and our discount depends on the duration of the transaction and the percentage of the advance. Now we can fund really up to a 90% advance against a single invoice that we purchase. And you get to choose what advance you take. 90%, 80, 70, 60, 50, 40, whatever you choose. Because the discount applies to the total face value of the invoice. If you choose a 90% advance, you get one discount. Or if you choose a 50% advance, you'll have a much smaller discount. So flexibility is built in there. Our discount is also prorated on a daily basis. For instance, if your customer pays us in 3 days, we only charge it for 3 days. If the invoice is paid in 41 days, then we charge it for 41 days. It's not from the day of your invoice, but it's from the day we bought your invoice and wired the money to you. In other words, by deciding when to sell an invoice and what advance to take, you control your costs. It can still be expensive, but we will teach you how to use the service effectively, cost effectively. You will be driving the process, and ultimately you'll be controlling your costs. All right, an example. Let's say you have a $100,000 invoice, and you know you're going to need $80,000 of that $100,000 before it's paid. But you don't need all of $80,000 immediately. So what I'd suggest is you take $20,000 now, another $20,000 at the end of the first week, $20,000 at the end of the second week, and the balance at the end of the third week. The discount will apply to each portion of that draw for only the period of time that it's outstanding, and that means that the combined cost will be much lower. This is how flexible spot factoring can be when you use it correctly. And you can draw the financing on your own schedule, not someone else's. All right, let's talk about pricing and our daily discount rate. For example, at a 50% advance level, our daily discount rate, which applies to the total face amount of the invoice, is 0.1%. 60, 0.12%. 70%, 0.17%. 80% advance is 0.196%. And 90% is 0.22%. If you need a 70% advance, for example, your daily rate is 0.17%. And if the customer pays us in 10 days, that would be 0.17% times 10, or 1.7% of the total invoice value. If the customer pays in 30 days, that would be 0.17% times 30, or 5.1% of the total invoice. That's it. No additional fees, no wire transfer fees, nothing. All right, here's a more specific example. Let's say you have a $10,000 invoice that you need to sell to IFG, and you need $7,000 immediately. Your customer sends us the $10,000 payment on the 30th day. We keep the $7,000 that we advanced you in the beginning. We take out our fee, which is 5.1% of the invoice, or $510, and we immediately wire back the balance of $2,490 to your bank account. That's it. Transaction's complete. Very, very simple process. Now let's say today is Wednesday and you have to make payroll on Friday and cash flow is running a little short. You open up your accounts receivable file, look at the invoices that you expect to be paid soon, and you see you have a customer that always pays in 42 days, and their invoice has already been outstanding for 22 days, which means you will only be charged for 20 days before that invoice is paid. So pick that invoice, sell it to us, we'll advance you the money to your account on Friday morning in time for payroll, and once that invoice is paid, if you need more funding, you just repeat this process. We will show you, again, how to use this very cost effectively. All right, let's talk for a minute about what happens if your customer does not pay when we expect them to be paid. Now, we expect them to pay according to when they usually pay. Your terms may be 30 days, but if the customer usually pays within 42 days, then that's when we will expect your client to pay. So if the customer does not pay when we expect them to, we're not going to call your customer, and we're not going to demand payment. You really don't want us to do that. We could destroy your relationship. So in our process, instead, what we do is we call you and we ask that you resolve this quickly. If you're unable to resolve it, then we will send the invoice back to you, and you're obligated by our terms to replace the invoice with another invoice from another customer. That's why we will never purchase more than 60% of your eligible outstanding accounts receivable. So to summarize, we can purchase up to 60% of your total accounts receivable and fund individual invoices we purchase at up to 90% of face value. We need 40% of your AR free and clear in case one of your customers does not pay when expected. And you can always buy these back or prepay an invoice. Again, spot factoring is a very, very flexible financing service for you. Now here's how the process works. If you like what you've heard so far, I'm going to send you a very simple one-page application. You fill it out, email or fax it back to me with the following 4 financial documents: a P&L, a balance sheet, an aged accounts receivable summary, and an aged accounts payable summary. If you use QuickBooks or similar financial software, they'll basically tell you how to pull these reports in less than 5 minutes. Now, once you send them to us, we will immediately review them and call you back same day with any questions that we may have. Then we'll ask you to send us copies of the invoice that you wish to sell, and we'll help you with that, along with any backup documents such as purchase orders, contracts, and then if everything's okay, we'll prepare a financial package and send it to you electronically, get on the phone to explain it to you, and answer any of your questions. Now in the package there'll be one document for your customer to acknowledge, and that tells him that payment of the invoice has been assigned to IFG and that they have to pay us directly. You will sign this document, forward it to your customer, who in turn will sign it, fax it directly back to IFG. We'll have a short call, very short call with the customer verifying signature, and then if everything's okay, we'll arrange a short meeting with you, cover any final details, answer any more questions you have, and if that goes okay, we'll wire transfer the requested funds to your account that day. So if you're motivated to get this done quickly and you're ready to cooperate with us and getting everything that we need, then we could potentially be in a position to give you the requested financing by the end of the day tomorrow. Now that's pretty quick, but it can be done. Now I can assure you there'll be no unnecessary delays on our end, and we look forward to delivering the working capital to your business just as soon as possible. What do you think we should do next? All right, so that's basically the conversation that I have with the customer, or I'm sorry, with the client, taking them through it. Hopefully this will help you out, and we also have the backup documentation and the script if you'd like to have that. But at this point, I appreciate your time, and it's time to say goodbye. Take care.